Hi folks, Rob Flux here from Property Developer Network, and welcome again to another Sunday session. Now this week's Sunday session is a little bit different to usual. So it's not just myself involved, but we've actually got a panel of 4 experts in and around the property lending space. They're going to help you to answer all your funding and lending questions, both in a residential development and also in and around what's going to happen in the market with this COVID thing going on. So with that said, we have on our panel today, we have Yuhan Liu from Mortgage Choice. We have Krishna Pabari from Acquire Capital. We've got Mark Trainer from Stack Capital and Eric Trieu from Holden Capital. So hello gents, how are we all?
Hello everyone.
Hello Rob, hello everyone.
So I might just start in not in alphabetical order, in the top of the order. So Yuhan, why don't you just tell us a little bit about yourself and your business and your perfect client space, I guess.
Sure. Hi everybody. So I'm a franchisee of Mortgage Choice. So between myself and my business partners, we cover the footprint basically for most of Brisbane, the Logan area, and also the northern part of Gold Coast. So our primary customers are residential lending, and we do extend into commercial and business lending, and also some parts of asset finance as well. So we tend to sit on the start of the journey, I guess, for the interest of the property development network. We tend to sit on the startup journey for developers where they need to source the initial capital. And we also work heavily towards the end with regards to the finishing products. So we can assist the buyers to be able to complete their purchases at the end.
Excellent. And Krishna, tell us a little bit about yourself and Acquire Capital, mate.
Thank you, Rob. Acquire Capital is a small private lender. We specialize in short-term mortgages. So our lending product is first mortgages over property in Southeast Queensland. I guess the difference between Acquire and others in the market is we're funders, we're not brokers. So we use our own money, we have investor capital and our own capital. I personally have been doing property deals full-time for around 25 years. I've got experience across all areas of property. Over the last 10 years, I've done 200 deals. I work with John Pepper. He's our credit manager. John's got around 20 years experience in property and business finance. So we make decisions in-house between John and myself. We don't take fees up front, or not big fees up front. And the last 10 years, we'd count on one hand how many times we've issued an offer and not proceeded to fund it. We're about being reliable and flexible, and we're Southeast Queensland.
Perfect. Mark, tell us a little bit about yourself and Stack Capital, mate. Mark, I think we've...
Sorry.
Yeah. Sorry, mate.
My back, my internet was just...
Tell us a little bit about yourself and Stack Capital.
Sure. Mark Trainer. So we've started Stack Capital a few years ago. We're a property and business corporate finance debt advisory firm and brokerage. So we specialize in property development and business and corporate finance. We tend to do a lot of townhouse and apartment projects, but we also do the smaller end as well. We're all 4 of us that are in the business. We're all ex-bankers, so property and corporate bankers from the major banks, Macquarie and the like, and also worked in-house with property developers.
Perfect. And last but not least, Eric Trieu from Holden Capital. Eric, a bit about yourself and Holden Capital, mate.
G'day, mate. G'day, everyone. It's definitely interesting what we've seen across the market. So our sector, we are both on sides of commercial brokering, but also we have a fund that we manage. So we do a bit of both. We do deals right across Australia, small deals from $1 million up to $100 million in funding. So we do townhouses, we do commercial, we do land subs, we do splitter blocks, you name it. As long as it's commercial, it's more for developers. That's our cup of tea. Yeah, so that's us.
Perfect. Okay, well, thank you, gentlemen. Appreciate that. Now, I've got a couple of questions to start the process and get the ball rolling. But really looking for questions from, I guess, our Facebook community. So putting the call out now, folks, that there's usually a little bit of a delay between us requesting the questions and you guys actually typing them in. So I'm going to start the ball rolling. I've got a couple of questions for the panel, but really looking for you guys to have a little bit of a say in what do you want to hear right now in the market. So In no particular order, gents, some of the economists out there are predicting anywhere between 10 and 30% in property values. So what's your particular view of the market at the moment? I might go in reverse order based on the way we went before. So Eric, do you want to go first, mate?
Rob, that's a great question. I mean, everyone's got that on their mind right now about COVID and how it affects us, I guess, in property or lending. And a lot of people are talking about up to 20, 30% drop. But I think in reality, we're seeing a lot of deals right across Australia. Probably Sydney has the more of a, I guess, concern. Other states, probably not as much. Brisbane, for example, we're seeing us pretty steady. We haven't seen any alarm bells at the moment. Talking to a few valuers, they've been sharing probably up here, maybe stagnant, if not maybe 3 to 5% drop. That's what they may be seeing. But even them, they've got some question marks too. They're not certain of where the market's going with COVID. It is a new thing. It's unprecedented. So it's more trial and error, but more so probably Sydney has more concerns.
Yeah, absolutely. So Mark, yourself, what do you think about your projection as to where the market's heading, mate?
I'll start by saying that I think that anyone who tries to forecast with too much accuracy is the whole term unprecedented. It's we're all just really guessing. But fundamentally, property markets are really driven by supply of capital and by employment. So we're going to be facing some unemployment issues in this country. So we'd expect there's going to be some effect lending space, which therefore drives the demand for housing at the end of it. I think unemployment's looking a lot better than what it was forecast to before JobKeeper came in. So we're looking pretty good. But I think, the thing that I really don't like is when people talk about the property market as if it's one market. Even within Brisbane or within Sydney, there are just so many different markets. If you looked at Sydney, Western Sydney versus North Shore, it's just completely different markets with different drivers. So I think we'll really see patches where, as Eric said, Western Sydney, high property prices relative to incomes. So I think we'll see some variances between markets.
Yeah, I imagine so. Well, that's the case all the time. So if anything, I'm going to say that those markets are going to be exaggerated as we come into this sort of period is kind of my take on that. Krishna, yourself, mate, what do you think as to how and where the market's going?
Look, we're cautiously optimistic about the market, particularly in Southeast Queensland. I expect some downward pressure on property prices, but I think Queensland is somewhat cushioned from the types of numbers that the economists are predicting. And that's just a product of the area we're in, or rather product of the area that I'm in. I believe Southeast Queensland hasn't seen the rapid growth like southern states over the last few years. And there's a belief that Queensland won't have the large drops as a result. Also in Queensland, I can say that we've seen firsthand the tightening of the investor market over the last 12 to 18 months. And it would seem this is going to be the area that's going to have the greatest impact. I see new opportunities. For example, residual stock from completed product will take more time to market. We're well positioned for opportunities like that. Look, one of my favorite quotes is from Wayne Gretzky. He was a Canadian ice hockey player. And he says, you skate to where the puck is going to go. So for me, it doesn't matter what the market's doing. The question is, what am I doing and what are you doing? This is time to go back to fundamentals. Let's ask questions like, how can I add value? Where is the opportunity?
So another famous quote from Wayne Gretzky, Krishna, is you miss 100% of the shots that you don't take.
Yes.
So great time, I guess, to be preparing for, I guess, the impending opportunities that I think are coming anyway. But Johan, lastly, mate, what's your read on the market? You're, I guess, more in that residential space and seeing a number of lenders tighten that I've seen in that area. So, but what's your take on things at the moment?
Yeah, very interesting times. I'll probably say, because we're on the cold face, we deal with buyers. I guess workload-wise, it's surprisingly, I think I share the sentiments with everyone else in relation to Southeast Queensland specifically. It's been a little different. The momentum is certainly different, but in terms of the actual workload, it's actually probably it's surprisingly picked up better than what I expected. when we head into COVID-19, when they start I guess the so-called shutdown, at the time I basically said, look, it'll be interesting to see how deep that cliff was in front of us. And I was sort of predicting maybe by June we'll probably see some sort of effect. But surprisingly, as we actually head into April and now to May, it seems to be more like a curbside or like a 1 meter fall rather than like a 100-meter fall down the cliff. So, and also from a property market point of view, I guess, this is my personal prediction. My take is it certainly will experience some sort of price drop, but the thing is, it is on small volumes. It is actually affecting on a small group of people as opposed to probably a structural type of issue, but that's providing if the COVID-19 issue sort of subsides sooner, then look, I think it's actually subsiding probably a lot sooner than what everyone else has been predicting over the last few months.
Yeah, very good. So having said all that, so thank you, gentlemen. Appreciate your point of view on the market itself. But I'm really keen to find out, given that you all represent different areas of the market and different client bases and the sources of your money come from very different places, I'm very keen to understand, I guess, the actual lenders of the money. So whether they be private or whether they be corporate, what has been, I guess, the changes that you've seen in their risk tolerance, and what specific additional measures do you think that they've started to put in place to try and, I guess, curb the enthusiasm of people going a little bit too gung-ho? Might start with Krishna this time around, mate.
Thank you, Rob. Look, lending in the private space is largely about risk. We can have quality borrowers, we can have quality assets, but it's about managing our risk on the way through. So our risk tolerance has changed on certain types of security, and not just this month, but over the last 12 months. So for example, over the last 12 months, we're finding ourselves lending less on townhouses and units and more so on vacant land. Construction and development for us generally are being perceived as higher risk this month than they were last month or 6 months ago. As a result, loan to valuation ratios are more conservative. That's definitely happening. And we're finding borrowers coming to us with 45% LVRs, with 30% LVRs. We have a client this week who wants to borrow $200,000 on a $1.5 million completed house. Those sorts of opportunities we're coming across for lending, and those sorts of loans we're considering, and we're happy to write. We also feel exit strategies are changing. Refinance is not as certain right now as it might have been. And if a property is going to be sold, it might take a little bit longer. But keep in mind, we're short-term loans. We lend money for 6-month and 12-month horizons. We don't generally look at serviceability and rental income. We look at what's the exit strategy. And if it's perceived that there's a short-term change in the market because of COVID, the economist is saying it might take a year, it might take 2 years to recover. On a 6 to 12-month loan, yeah, we're in the midst of it.
Does that mean that you're not lending at the moment, Krishna, or does that just mean that you're a little bit more cautious in how you're doing that?
No, we're definitely open for business. We're definitely willing to write loans. Look, we're always cautious. I think you find as a general statement, we're looking for borrowers to have a slightly stronger balance sheet than they might have before, to have a tolerance for if it's a project that it might go longer. If it doesn't quite get the ambitious numbers that are being put forward, if it gets 5% less, if it gets 10% less, does the development still stack? Those are the sort of questions we're asking ourselves. And when a client comes in with a lower risk, it's priced accordingly.
Very good. Eric, what about yourself, mate?
Look, Krishna, you brought up quite a few valid feedback. I mean, we're seeing things on both sides. So on the lender side, totally agree. Majority of them have pulled back on the risk. So the LVRs, traditionally, they would have gone to, say, 65% LVR. Now they're generally pulling back to 50, 55. Construction, you mentioned about that side. We do a lot of that in our business. Now we're seeing a lot of lenders pulling back to not do construction in the space, and they're reviewing that every 2 weeks or so. So that's quite interesting. We had a few loans set during probably say a month ago, and when the stock markets dived, they put a hold on a lot of things. That's generally where they were raising their funds, and they pulled out completely. So they're more doing a lot lower risks, as Christian mentioned. So they may do sub 50% LVR. Above that, they won't even look at it. So that's on that side. Definitely seeing a strong demand from borrowers and need more capital, or if it's a case of the gearing's dropped, they need a bit of mezz or equity or a prep deal of such. Our fund, we've been settling quite a lot of deals of late, and investors' appetite is still there. They're more worried about the stock market and property. If it's first security, that may, I guess, more safe in their opinion, and they're more willing to take action. So that's what we've been seeing.
Excellent. And Mark, yourself?
We've seen a real mixed bag. There's been, as the other guys said, there's been a lot of lenders who have pulled out or significantly pulled back on their gearing levels, but then we've also seen others who have made absolutely no change. They're still lending at the same LVRs, same pricing, same terms. And then there's some that are somewhere in between. So it's all over the place. So, you know, over the last 6-8 weeks, we've just been on the phone every day to everyone we know, just seeing what they're doing. And what someone says they're doing this week might not be the same as what they're doing next week. It really just has been moving at such a rapid pace. But I guess, overall, risk is certainly the big focus. Nobody knows for certain where this is all going. And so lenders are being more cautious, which does mean that as a borrower that you need to be going to lenders better prepared than maybe you would have had to have been 3 months ago. Have a clearer picture of what your strategy is, what the potential downsides are, what your plan B is. So just be prepared.
Yeah, very good. Thank you, Mark. And lastly, Johan, yourself, mate, the residential space, how are you seeing that tightening up? Seeing all sorts of funny things going on with people like ME Bank grabbing funds and all sorts of stuff going on in that resi space, mate?
I think, look, with those kind of events, it's probably really boiled down to the way how they executed, and also the timing in terms of when they've actually chosen to execute something like that. But otherwise, look, there is definitely tightening across the board, just in relation to, for example, documentation requirements. Some banks were asking for documents up until 30 days old. Now they're basically saying, guys, look, we need documents up to 14 days only. So no older than 14 days. Additional questions are being asked. So I guess, in a way, I wouldn't call it, those are probably more so just in terms of the supporting documents. It's not so much of a tightening, but it's more so for them to, I guess, to ensure that they don't end up having to put a new customer on life support immediately after a deal has settled. But I guess, at the same time, for those who are buying new stock, for those customers who are either buying house and land packages or anything potentially off the plan, what we've sort of been trying to work with them is we basically try to educate them to let them know, hey, we need to not only plan for the time being, so based on what we've seen right now from a policies point of view, but we also need to, I guess, ensure that further down the track, if the purchase was, let's just say, due for formal approval in 3 months or maybe 6 or 12 months' time, we try to sort of build in a bit of buffer. So, or try to, I guess, create less headaches for the vendors. So ultimately, obligation is on the buyer to be able to settle, but we also, hopefully that we can try to remove some of the headaches that may potentially come further down the track.
Very good. Okay, well, what I might do, gents, so thank you for kickstarting those with some of my own questions. What I might try and do now is just go to our Facebook audience and see what kind of questions they've got coming through. So I can see Karen has got a question here. No, it's just saying looking forward to the session. So thank you, Karen. Appreciate that. Luke's got a comment here that Channel 7 News have advised yesterday that there's actually been an 18% increase in listings in the past week. Are any of you hearing, I guess, that listings are coming up? And if you have, what's your opinion on that? And I'll do a free-for-all. I won't name anybody out here, but
I'll jump in and say that listings got pulled back very quickly when COVID hit, which from what I heard is a lot of agents just taking a view of, well, we can't do open homes, and a lot of people saying, I'll just pull my house off the market now. It might not be the best time to sell. So rapid drop, then, goes back up again. Doesn't necessarily mean it's it's all guns blazing. It just means that perhaps people that pulled out in the panic have maybe decided, okay, let's get back to selling now.
I would agree with that. I've spoken to a few agents recently, and it wasn't a good climate, correct? So if you weren't doing auctions, then it wouldn't potentially get the highest value. So a lot of the vendors just put properties off the market. I've seen the property near where we live, where there was a sign came up and it just said, coming soon. That's all it said. So, oh, that's interesting. Got our attention. It was like, is it for sale? Is it not? Is it for auction? So obviously they're holding back and waiting for the right timing. So it's interesting times, that's for sure.
Johan, you've probably got plenty to say in that resi space, mate.
So look, it's actually quite interesting when we first started for the first 2 weeks or so into COVID-19. We did have quite a few inquiries in relation to pre-approvals, or I guess people who want to lowball. We also have a lot of customers where they sort of ask, I guess the ones who are more concerned in relation to the price drop, so they may be a little bit hesitant to buy. But I guess, after talking to especially agents, the main thing is the fact that when there's no inspection, where they cannot showcase the properties properly, it is actually very difficult for them to, especially with agents, when they really work for the sellers, it is actually very difficult for them to try to get the right dollars or the best dollars for the sellers. And also, so as a result, so similar to what I said before, if I were to see any drops in prices, I think that's likely going to do with the smaller volume as well, as opposed to a mass market price drop.
Very good. One of the things that I've been witnessing, gents, is that certainly from feedback within the community, is that banks seem to be a little bit more hesitant at the moment because nobody knows if the person who's actually employed is going to stay employed. And nobody knows that the security that they're holding with investment properties, whether or not the tenant is actually going to be paying rent. And so I've seen a lot of feedback on tightening in and around those spaces. And I've also heard quite a bit about valuers, I guess, predicting the future, even though they're not meant to be doing that. So any of you got any thoughts and feedback on that sort of thing?
I might jump in with that one, I suppose. Krishna, sorry, I probably should let you get going first. But just in relation to that, I guess, so coming back to the renter side of things, so we see banks that they are taking a bigger haircut on the rental income side of things. Some banks where they used to take, back in the old days, it was 80%, but we now have certain lenders where they say, look, we only look at 50% of the rental income. And also plus, other than seeing simply statements or lease agreements, they're asking for bank statements to confirm that you've actually been receiving those rents in the last couple of weeks. And also the other thing is we also have some lenders where they've actually broken the investment property related expenses out from the living expenses calculations. So traditionally it used to be, it was a basket case back in the old days, but they've actually now taken it out. So not only they've actually reduced the rental income that can be utilized, but they've also taken the investment property related expenses out and factoring in a different part of the equation. And also probably what doesn't really help in that space is the leap and bounds in increases of the so-called HEN or the household expenditure measure, or the minimum living expenses that the banks would actually use to qualify customers. So it's a bit of a, I guess, it does sort of all add up and actually having a bit of impact. Probably more so in my space, I suppose. I'll be curious to see how this affects the other panelists.
I think with valuers, we've certainly seen, valuers are inherently quite conservative people for the most part. And there's a bit of a saying that they follow the market on the way up and they lead it on the way down. We're certainly seeing valuers being more conservative over the last couple of months. Valuations are coming out with a special COVID clause in there saying that the valuation's only good as at today, as opposed to the usual 3 months. And we're certainly seeing, we've seen examples in the commercial property space where properties are valued based upon a capitalisation rate, and say that valuers have said straight out to us that okay, 3 months ago, I would have put 6.5 on this. And today I'm probably going to put 7% on it, which does drag the property value down. So yeah, we've certainly seen conservatism coming through.
Sorry, gents, look like I had an internet outage. Hopefully we're still actually live on Facebook. We all back, are we?
You're there.
Yeah.
Sorry about that. I had to very, very quickly jump to a hotspot. So that's the fun of technology, right? So let's just make sure that I haven't lost everybody in that process on the Facebook feed. But it looks like they're still going, so quite fortunate in that regard. Okay, some other questions. I can see one that's come through from Jane Pryor. I don't quite understand that question, Jane. You've said what would be a qualified statement. So maybe if you can flesh that one out a little bit more, we can come back to that. That would be fantastic. Luke's got another comment. Are there so many markets? There are so many markets within Sydney, markets going up 70% between 2012 and 2017. So he's saying it's not consistent across all suburbs, and that's pretty consistent. Doesn't matter where you are, there's always markets within markets. So you know, when you see great big statements like Commonwealth Bank saying, you know, property market likely to drop upwards of 32%, they don't mean everywhere. It's, you know, there might be select areas. Jim Valerie's got a question. Oh, sorry, Johan, were you going to say something, mate?
Yeah, all good.
No. Jim Valerie's got a question.
That was me. Sorry, I was just going to elaborate a bit more on that. That, you know, the big thing that we've noticed, and a few others we've been speaking to, is that the GFC was a rich man's crisis, and this one is right on the other end of the scale. It's people who are casual workers and lower income earners who are getting hit the hardest this time. Yeah, and over the last couple of weeks, conversations we've been having with a lot of developers are that developers doing really high-end stocks, so, you know, let's say $1.5 million plus price points with townhouses and apartments, they've seen absolutely no issues, and in fact, a couple that we've spoken to have even been having record sales. Whereas bottom end, so, you know, call it up to $400,000 or $500,000 price points, where the buyers tend to be on lower incomes, they've really been struggling with sales.
Yeah. So have another question here from Jim Valerie. So Jim is hearing commentary from lenders about reluctance to move into construction funding. So are the panels still open for all lending business, and what reduced areas are there, if any?
I can add a share there. Jim, g'day, mate. I think the reality is true. I think if we had 10 lenders that were involved in construction space, now you probably have 3 to 4 left. And out of 3 to 4, they're going to be a lot more stricter on their criteria and what to look at, the strength of the sponsor, the gearing requested, and all the extra, like the timing, the pre-sales at the end, term of construction. Yeah, definitely a lot more stricter in their criteria. So definitely it's a lot tougher now for construction.
Yeah, absolutely.
It's certainly tougher, but certainly not impossible. It's there's very much still a lot of activity going on out there, as I say. So, you know, don't think for a second that you can't get construction finance in this market. If your project makes sense, and if you as the developer make sense to the lender and they're comfortable with you, then absolutely there is still money out there for construction finance.
Well, it sounds like Jim might actually be in the market for construction funding. So I can see 3 phone calls going out to him Monday morning. Or maybe even 4, you never know. Okay, see who else has got a question. So Jane, I think this is more of a comment. Mark's presentation yesterday attested to money lenders having funds available to lend in commercial situations. So I think that's a yes across the board is kind of what I'm hearing from there. Another comment from Luke with regards to the Sydney markets having markets within markets. So I think we've already addressed that one. Trying to see what other questions we've got here. Tony Gallagher says, so creating a stick to a strategy is very difficult due to COVID-19. So what he's saying is he's wanting to stick to one strategy, but because of COVID-19, it's kind of thrown his plans out a little bit. I would say, mate, that irrespective of any market fluctuation like that, if you are strong in one strategy, you're going to know very well how that one strategy is going to respond in that market. If you're trying to become jack of all trades, you end up being master of none, and you don't quite get the traction you'd need. Would you gents kind of agree to that?
Yeah, definitely agree. We try to give customers, I guess, best case scenario and worst case scenario. We basically say, look, best case scenario works. Hopefully, worst case scenario also works as well. Or if it doesn't work, at least the customer knows what they're actually getting themselves into.
Yeah.
I'd like to respond on that one as well, if I may. This too shall pass in terms of COVID, but that doesn't mean it won't have an impact along the way. And if last month or the month before or 3 months ago, we thought townhouses were expensive and we were shy on lending on them, we're still shy on lending them, and we might be a little bit shyer. So what I'm saying there is, if something's had a run and it's high and we were hesitant on funding it anyway, that's going to show up now. It comes back to the fundamentals. But if the borrower has a really strong balance sheet, if they're experienced, if it's an owner-occupier product at $400,000 or $500,000 rather than an investor product or a high-end luxury product, we might still look at it because the fundamentals are right.
Very good. So another question from Luke's got plenty of comments today. So are you guys seeing share market investors moving their money to property? Are you guys seeing that?
We have seen some of that. I think everyone obviously diversifies, but for those clients that we are aware of who have a substantial portfolio in the financial sector, they've definitely put that on hold. Some have pulled out. Some more keen to look into secured property as a loan. Yeah.
I've seen it the other way around. My experience has been that people who've had money in the stock market and taken a bath don't necessarily want to crystallize that, but they might have money in fixed interest or they might have money in property, and they're saying this is an opportunity to re-evaluate their portfolio and put money into the stock market. So I've seen it the other way around.
Yep. So Jane's got a question. Would it be fair to say that in general, a more conservative approach across the board from all lenders, which means that as clients, we need to provide more due diligence, et cetera, et cetera. So you're seeing a lot more structure in the applications that needing at the moment, gents?
Okay, I'll answer that one. Look, Acquire Capital, we sort of lend outside the box. We're not people who try and put ticks in boxes. We look at each deal on its merits. But right now, we're looking closely. What's the background of the sponsor? Do they know what they're doing? Does it make sense?
Well, I've heard a couple of instances of people in our community where they've actually had finance approved, and then at the very last week prior to settlement, they've kind of pulled the pin. Have you guys seen that happen across the board, or just ad hoc lenders here and there?
Yeah, definitely ad hoc. There are some, ultimately lending is done by humans, and humans have their own personal views on what goes on. And we've seen some that have just completely pulled out, and anything that they haven't already written the checks for, are just pulling them out. We've heard of banks pulling of loans, thankfully not to any of our clients, but we've certainly heard of it happening in a number of instances. We've seen particularly at the institutional side. And so when I say institutional, that means lenders who are managing tens or hundreds of billions of dollars. Certainly at that level, there's been a lot more pullback, a lot more of we're just closed and we'll just wait for the dust to settle before we do anything else. Whereas at the smaller end, that's probably where we've seen more of the activity just continuing. As I said before, in some cases it's been business as usual, but that's probably the minority. But most are certainly taking more care. And at the end of the day, we're in an uncertain environment. So when you're not certain of where things are going, then you just inherently need to be more careful about what you're doing as an investor.
I think also it has changed over the last month. a month ago, when we were entering this crisis, or at the earliest end of this crisis, people didn't know what was going to happen. They hadn't yet formed their view, and there was a degree of panic. However, we're a month further in. We're probably 6 or 7 weeks since it started, and I think Queensland's down to a dozen cases. So people can see the doors opening. They can see themselves going back to work, and they can see a normality will come. And I believe there's confidence this week that was not there a month ago.
Yep, I agree.
Yeah, I'm starting to see a little bit of that coming through myself. It's funny the difference a week makes. When the media start jumping on things, it's like the old Chicken Little and the sky is falling, and people tend to have a herd pack mentality, and so when a couple of people are leading the charge, then everyone kind of goes, well, where are they going, and they start to follow. So it's interesting watching that actually occur. Have another question here from Ravi. How do you see when the stimulus packages by governments relating to JobKeeper and JobSeeker end in September? What do you think will happen to the property market when the unemployment percentages may be higher at that point? Because everyone's predicting, 10% unemployment, and if there's no more JobKeeper, how are we seeing the market at that point in 3 or 4 months' time, gents?
I personally believe, look, again, this is crystal ball stuff in reality, so we're all really guessing. But look, Australia is in a very enviable position compared to the rest of the world. As much as people can say the government's getting in a lot of debt, the reality is that our government has far less debt as a percentage of GDP versus most first world countries. So there is a lot of ammunition still available. So we're not going to be in a situation whereby the government can't put more money in if need be. If we're getting to September and it's looking like unemployment is not getting better, then the government doesn't want to be promising that they're going to be throwing more money in because they've got a lot of conflicting issues to manage. But they absolutely have the money to do it. I think we'll see the government putting a lot more money into infrastructure. That's pretty typical during recessionary times. So create jobs. The government should be pumping money in to create jobs. I think the JobKeeper's everything's happened so quickly that everything's fallen off a cliff in such an unprecedented rate that they've had to put in money in this form. But now it'll be the focus on how do they get money into the community long term and into business.
Yeah, I'm predicting that there's going to be a heck of a lot of government infrastructure projects that kick off that's going to stimulate jobs and very much in the construction industry, whether it's at the lower end of the scale where some of our viewers are, or whether or not it's at the high end of town with roads and bridges and train lines and things like that. It's probably more the latter, but I think the flow-on effect will be fairly significant. So I think that's where I see the stimulus coming, rather than trying to prop up somebody's job, but actually go out and actually creating jobs.
Rob, I was really hoping the government would have a huge stimulus on new property and maybe abolish GST on new property for 12 months or something like that. But I don't think it's going to happen. I think this is time to actually follow the infrastructure. It's all public information. Look on Brisbane City Council's website, look on the Commonwealth Government's website, look on the state government's website. You've got to dig for it. But the suburbs that the government want to accelerate are marked. The infrastructure projects that are going to bring people to those communities are all clearly marked. And look, crisis equals opportunity. I see the opportunities.
Yeah, so it's not just Brisbane that have planned that out. I guess we teach people to actually go and look at the state government's infrastructure projects across the board and what are their strategic plans, planning for 20 and 30 years into the future in New South Wales and Victoria and the like. When people actually do their homework, you can see where the money's about to be spent. And I think now they're likely going to be bringing forward some of that spend is kind of how I'm reading that. Now I can see a question here from Linda that I think we actually covered with some of the commentary that went through before. So thank you for that question, Linda. If we didn't quite cover it, then feel free to I guess, further clarify that a little bit if you could. A couple of people commenting on the fact that they didn't miss me while I was off air, and you guys kept on talking amongst yourselves clearly. So thank you, gents, for keeping that alive. So I got a question from Jane. Do we need to be more diligent in our due diligence? I'm going to say yes, very clearly. I think you should always be diligent in your due diligence, but right now you're probably going to be asked to dot every I and cross every T. And where you have done that, you're probably going to have to show it in triplicate is kind of my take on the world. Is that how you guys see it?
Spot on, Rob. I totally agree. You rather think about a project 10 times more and getting involved rather than jumping involved and unconditionally have to settle and then you think, oh, now what? You'd rather have plans B, C, and D, to be honest. You've got to expect the worst and hope for the best. So as Mark mentioned, it is unprecedented times. No one really knows. So you've got to plan for the worst and just being very conservative. Have a larger buffer. So traditionally, if you had a 15 to 20% buffer, maybe expect a 30 to 40% buffer. Yeah, more conservative.
Yep, very good. Have a question here from Justin, and I'm going to try and interpret it because I think he's written it shorthand, I should say. So what movement have you seen in some of the ratios that the lenders are lending to? So things like your total development costs and your GRVs, have they changed their percentage ratios in how they're assessing loans at the moment in that space?
We've seen 5 to 10% is a pretty broad brush number. A lot of lenders have gone from, if they were doing 80% of cost, they're doing 70 to 75. If they were doing 70, they're doing 55, 60, 65. So yeah, 5 to 10 is a pretty fair number across the board generally.
We've been doing a sensitivity analysis. We've blown the timeframes out by a period. So before we were allowing 6 months for a project, we're now saying, well, what if it took 12 to sell down all the stock? And we're also saying, well, what if it didn't get the GRV and we had to shade it by 5, 6, 7, 8, 9, 10%? Is it still viable?
I think that goes to the due diligence question before as well. If you're in a strong rising market, so like Sydney and Melbourne have been for a number of years there, you can afford to make mistakes because there's margin in it. If you bought the property and townhouses at the time were worth 700,000, and by the time you finish it, they're worth $1 million. No matter how many mistakes you make, you'll probably still make money. Whereas now we're in a market where there's a risk of values going down. So if anything, potentially eroding at your risk margin. So that's particularly at the front end as a developer, you really need to be doing more due diligence to make sure that as well as you possibly can, that there won't be any hidden surprises come up that will further erode at your margin.
Yep, absolutely. Now I've got a question that I think is very specific to, I'm not quite sure how to pronounce this name, Subodh. I guess, what is the panel's view on bridging loans for prestige property development, i.e. 4 mil moving to 6 mil of land plus 3 mil of build? So very much in the prestige space. I guess I might frame it a little bit differently. Are we seeing, I guess, the high end of town valuations being impacted more than the low end of town? That's probably a better way of framing the same question. Nobody wants to jump on that one?
So my experience over 20 years of being in property is that luxury properties go up a lot at the end of the boom and come down very, very quickly at the start of the bust. And I'm not suggesting what may or may not happen with this particular property, but there's a lot of caution around that. And so then it comes back to, what are the alternate uses? If it's a $6 million block of land, what's that $6 million underpinned by? Is it waterfront land? Could it be rezoned for high-rise developments? Are there other things that are underpinning that value, or is it simply supply and demand? And right now it's in heavy demand. And is that demand still there today?
Yeah, good question. So reading between the lines on that, Krishna, is blue chip properties are about to come on sale. Is that what you're saying, mate?
No, I'm not. I'm not even certain there's going to be a lot that sell because interest rates are really low, and if people need to sell it, they will. But I'm not seeing things happening in the market that are going to force people to sell property.
Correct. We haven't seen it. I think papers were talking about it potentially 6 to 8 weeks ago, saying there could be a lot of distressed sales, but we haven't seen it. I've got potential clients sitting there waiting for sites that's dropping 40, 50%, but they just haven't. We just haven't seen it. So yeah, Chris is probably right with the low interest rates. They'll just hold it and wait and see it through.
And with
Yeah.
the low interest rate and also the deferments and also the job keeper, the job seeker, I think the government has actually instilled a lot of confidence in the market to, let's call it popular for the time being. So I think that does have a strong impact in relation to the market. We're not seeing any sort of panic sales. And going back to what everyone else have said, if they have to sell, they have to sell. But those who do not need to sell, they're basically just holding back.
I think the question we need to ask though is the buyer who's got $6 million for a block of land and $3 million for development? I'm thinking that's a $12 million luxury property we're talking about. A year from now, when that property's finished, is that buyer out there with $12 million like sitting in his pocket that he's just done a deal of? He's sold his company, he's floated his business, he's done a successful property development. Are the factors that are going to give him that liquid cash to spend going to be in the marketplace a year from now when that property is ready to be marketed?
Yeah, and I think timing that right now when the economy in itself is slowing down, I would hypothesize that most businesses are not going to be liquid, and most business owners are not going to be liquid to that level in that sort of time in the next 2 years at least. But after that, absolutely. Yeah. Jane's got a question, I think that relates back to one of the comments we were talking about a little bit earlier. She's referring to banks defaulting on loans, but I think that means just not funding where they've already approved. How can we ensure against that actually happening, assuming that we're still in the deal? We might have gone unconditional, have got an approval from a bank, and then they pull out at the last minute. How do we avoid that happening?
It firstly depends on how far through you are. So a bank's approval, it is a legally binding contract and a loan document with them once you've signed the loan contract with them. So I've certainly seen instances in the past over the years where a bank will try to pull a withdrawal after loan contracts have already been signed. And once the threat of lawyers gets involved, then the bank very quickly turns up back at the table. If all you've got as far as your approval goes is a verbal approval and nothing's been issued, then you've kind of got an approval, but you don't necessarily. So they still have a legal ability to get out of it. So look, at the end of the day, it's probably just if you're concerned that they might pull the approval, it's really the same situation as if you're trying to get the approval. They need to be comfortable and perhaps you need to be proactive with your conversations with them and be getting the message from their credit department as to whether they are absolutely still 100% in the deal. And if you're at all nervous, then be looking for a plan B.
Yeah, and hopefully if you're using a broker, such as any of the panel here, you guys would have visibility of that sort of thing early, and you'd be coming up with a plan B along the way just to make sure that that's not going to catch anyone short. So if you're trying to go direct to a lender, then you're kind of trapped. But if you're going through any of these gentlemen on the panel today, then I can assure you that they'll be wanting the deal to go through, because otherwise they don't get paid. So they'll always be looking for a plan B. Next one. Sorry, Krishna.
Sorry, I was going to say, to answer that question in the short-term space, choose your lender carefully, because I have seen it happen where lenders don't complete. And I'm not talking about in the COVID environment. I'm saying people get to the day before settlement and find they've got a problem. And we get those borrowers coming to us saying, look, we've had funding fall through. So what I would say here is choose your lender carefully. Yes, it's nice to get a letter of offer, but actually ask your broker, have they had firsthand experience with this lender before? Have they settled deals for you before? Find references, talk to their clients, talk to other people who borrowed money from them. I believe in the market we're in right now, that's more important than ever.
Agreed. So Deborah's got a question. How do lenders view the lack of international travel and tourism and the effect it's got on the market? So for example, Airbnbs are turning into rentals. I guess there's no international buyers, all that sort of stuff. How are we actually seeing that impact the market, gents?
Oh, probably jumping on that one, given that that's probably sitting fairly squarely in our space. So we are seeing certain lenders where they stop taking short-term rental income as part of the for servicing. And also, you know, in relation to certain industries, for example, I've got customers where they are working for car rental businesses. So they may well be on JobKeeper. The lenders who will normally accept those, but because they're actually in COVID-19 impacted industries, they may only go up to, for example, 80%. Because the mortgage insurer is not willing to take anyone who's actually working in that particular industry at this point in time. So yeah, we're certainly seeing those kind of impacts. And obviously, you know, we try to make sure everything is actually being dealt with up front, so we know where the customer sits.
I think there's a bit too much concern out there about foreign buyers. You know, if you go back, I guess probably 5 years or so ago, a lot of apartment developments were getting sold to Chinese buyers and Hong Kong, Singapore, Malaysia, you know, all of the Southeast Asian area. There was a lot of sales going through there. You know, a lot of states have certainly put on higher stamp duties and they've made it less attractive. And so I've hardly seen any developers selling to foreign buyers over the last couple of years. Maybe in certain markets, perhaps say inner city Melbourne high density apartments, they've probably still been getting a decent number of offshore buyers, so they might get impacted more. But generally, I don't think foreign buyers and not being able to get here is going to really make any material difference. I think the one risk factor, which is kind of there's a downside, but there's an upside, is in tourism areas. So if you say Gold Coast as an example, Gold Coast has a lot of obviously, you know, accommodations right off at the moment. There's hotels are not doing too well. The people who are working in that industry don't have a job at the moment. But on the flip side, with borders about to open up and people, domestic borders about to open up and Australians being allowed to travel, you're not going to be able to go on holiday to Bali or Europe or the States or wherever. So if you want to go on a holiday, you're going to have to go domestically. So that might very well help markets like the Gold Coast with a lot of domestic tourism.
Yeah, I think just following on from that is you got to target your local market. So you can't expect FIRB sales, foreign sales, or even interstate sales. You got to maybe look at local market, look for market acceptance. Is your product something that the market wants now? Is it owner occupier? Do you think about space? Do you want 5 bedrooms or 3 bedrooms, or should you be doing more studios? So you got to think about your market and test that market. Talk to your local agents and seeing what their clients are asking for. Affordability, living spaces, spare spaces, things like that. We had a client in Adelaide I spoke to this week, and interesting enough, he only had, I think, 10% sold to Hong Kong. Balance, 90% was sold locally in Adelaide. So I was quite surprised at that, but it was all sold through local buyers. So I think that's a good product, obviously, and the right pricing.
Very good. So I have a specific question. I think it only applies to one of the panel members, but does anyone on the panel specialise in rooming home finance? So that's Endpoint. So I know 3 of you are more in the development and construction space, but Johan, it's probably more aimed at you, mate.
Rooming home finance. I'll probably say there are opportunities for those lending, but the thing is, the way how they will look at it, they will not necessarily look at the rooming finance right at the beginning. So you may well have to buy for example, as if it's a standard rental property. That's one. But if you're actually buying a student accommodation right on the outset, there are definitely restrictions. So it used to be, I guess, a hot color property a number of years ago. It may not necessarily go so well these days. But yeah, they're certainly lending. However, the lending is definitely reduced. So so typically it will be somewhere between a 60 to 70% LVR kind of lend.
I might suggest that Matt reach out to you privately, Johan, because he's got a couple of questions in that regard. I can see down the pipe. So Matt, I'll pass you Johan's details later on, mate. Tamara's got a question. Are you seeing more conservative valuations because of COVID? And do lenders take this into consideration? Now, I can say that they're not legally meant to do that. I commented before on the fact that they're crystal balling, but in my humble experience, they're meant to only use physical real world examples for their valuations. The problem is that real world examples are in the past, and when the market's dropping off, it's very hard for them to use the past to do that. So I typically see them, because they've always got a range that they can come in. I see them kind of going at the bottom of the range wherever it's a dropping market. Will you guys kind of concur with that kind of agreement?
I'll talk about it from a resi point of view. I think, yeah, because I had a couple of interesting experiences recently. And specifically, I'll probably should also say for those who are better versed in this space. So we're talking about 95 lending, so people with very minimal deposits. So we had a couple of customers buying in, for example, lots of Pollara, Parkridge, Logan Reserve, down in the Coomera area as well, where traditionally, and also Yorabilba, we traditionally see, I guess, for new house and land packages where the valuation have been coming back short. But for some reason, I think potentially thanking to COVID-19, because the valuers are able to put a blanket risk commentary in relation to the market segment or the market movement, they kind of gave us a full value. So the full value based on the contracts as opposed to falling short. So I was actually quite surprised with a couple of these that I've actually seen. I think, otherwise they may well take another different approach where they drop their valuation, but the risk levels are probably low. But whereas in this case, they've actually given a higher risk value, risk rating for the market condition side of things. But in exchange, they've actually given us a full value up to the contract price.
I think one of the key points, there's a big difference between residential, as in a residential valuer doing a straight house or a single townhouse or a single apartment, versus commercial valuers who will do the valuations for developments. Residential valuations, bank or lender orders it, and it just goes into a kind of a black hole, and some random valuer gets picked, and good luck with what you get. With commercial valuations, it's a smaller market. I mean, we certainly have relationships with a number of valuers, and some valuers have got different views on things. We tend to use valuers who are pragmatic, who will listen to reason, and won't just run for the hills and put a low number on it just for the sake of it, just because they're scared. But one of the other big things that you can really do is, as you pointed out, Rob, that the valuers do have to use actual evidence of sales that have gone through. So don't necessarily just appoint a valuer and wait for them to cross your fingers and hope that they'll come back with a good number. As much as you can, feed them information. If you've got evidence of sales that support the prices that you're trying to achieve, then supply them with that evidence. And if they don't use that evidence, then ask them why not.
Rob, are you talking?
Sorry, thanks, mate. I accidentally bumped the mute. My mistake. Question from Daryl. Why are legal fees so high with private lending in the 3K mark when I'm sure that it's all templated documents? I'm not sure if that's a go at anyone in particular, gents, but I mean, I've got a point of view that I'll add at the end, but I'd be keen to hear what you guys say up front.
I'll answer. I'll say there's two factors. $3,000 is actually not necessarily so bad. I've seen a hell of a lot more than that from lawyers with private lending, and it does depend on the deal complexity. Look, if you compare it to a bank, if you go to a bank, and absolutely they're templated, and often with banks, they won't even go via lawyers. It's just going through the bank's internal process. So the banker just fills in the blanks and it spits out the documents, and there's literally hardly any cost there. So if you're used to that level of cost, when you're doing private finance, though, it's not, yes, there are templates to an extent, but the lawyers will be doing them a bit more from scratch. And typically they're also engaged not just to prepare the documents, but also to sign off conditions precedent and to handle a settlement. And fundamentally, lawyers are lawyers. They will charge on an hourly basis. Typically, usually with lending documents, lending deals, they'll agree on a fixed fee, but they'll take into account the hours they're going to do. And $3,000 for a lawyer that typically charges somewhere between $300 and $500 an hour, depending on who in the firm is touching the file, is actually not a huge number of hours.
Yeah,
I'll comment on that one if I may.
Go for it.
I've probably got the most experience around this one. Look, when we compare legal fees, I think you've got to look at who's doing the work. If we're buying a $500,000 house from a mainstream bank, they will have an internal department that does a cookie cutter. I've done commercial deals where I've gone to Bank of Western Australia or NAB or Westpac, and when they use external lawyers for the loan docs, it's the same sort of money, $3,000, $4,000, $5,000, $6,000, $7,000, $8,000. When it's a private lender, we use solicitors. We have no choice. And what often happens with us is we get someone inquiring about a loan on a Monday, and they might be 21 days into a 30-day contract and their other finance has fallen over. And so we've got a week to put the finance together. That includes meeting the borrower, doing our due diligence. So by the time we give the lawyers instructions, it's 3 days before settlement. And it means having a solicitor drop what they're doing, and they will bill their hourly rate as a solicitor of whatever the figure is, $400 an hour plus minus. And if the bill comes to $3,000, it's because they spent 8 hours on it. And we try and get that down as much as we can for our client. We generally we're not at the $3,000 mark, but we're in the twos. That's what our lawyers are charging, and it's commensurate with their time.
Well, I see lawyers charge, I don't know, Mark said as an hourly rate, they tend to charge in 6-minute increments. So every time I'm talking to my lawyer, it's hello, how was your weekend, is kind of not on the agenda. It's kind of, hello, this is what I need. So kind of get to the point. There's plenty of time to be pleasant at the Christmas party. So, Peter's got a question. How will lenders look at serviceability for self-employed people moving forward? I guess there's different points of view here because we got residential and also, I guess development style lending. But I might start with the development lending side of things. How much do you take into account somebody's day job, gents, as opposed to the deal itself?
We generally don't. We look at what's the exit strategy rather than whether the loan's being serviced. And we'd be looking at what's the gross realization, how long will it take to sell? Person's income matters less.
So,
sorry, Mark, when we talk to a client, we try to assess as much as possible with the client situation. So are they a client who's got a traditional mum and dad income, and this is the first or second project and it's on the side? Or is this a professional developer who's been doing this 20 years? It's a very different type of client and solution. Some cases, clients want the best rate, but we may need to advise them, look, because you're a traditional developer, you can't show serviceability weekly income, then maybe you need to look at options B or C. So that's where we would advise that accordingly.
Yeah, we do a lot of pure business and corporate finance outside of the property space. And what we've really noticed in that space is self-employed income or company income is very much still looked at, but there's certainly more of a what's the effect from COVID attitude. So if you've been running a hairdressing business or a restaurant, then no matter what you made last year, it's going to be looked at with a view of, well, what might you be making now? Because right now you're probably making next to nothing, and who knows what you'll be making soon. So there's certainly a lot more of a view on that. We've been having to put in a lot more attention to detail on forecasting and working through what we believe the effect might be on that particular business. As Eric said, though, it's always a case of looking at what's the impact of the income on the project. Projects can be quite different because projects will typically be self-supporting per se. You know, you're going to sell the end product and make repayments of the loan from that. But yeah, it's certainly a case-by-case scenario.
For us, it obviously weighs heavily from a servicing point of view. So it is definitely something that the banks are looking at carefully. So they've actually gone from, traditionally they can actually look at financials for the previous 2 financial years. Nowadays, not only they want to look at the tax returns and financials for the previous years, but they're also asking for the most recent, potentially, 2 quarters of BAS, and also bank statements, business bank statements for the last 3 months. So for all those lenders who are looking at the servicing side of things, that's the kind of things that they actually weigh into. And I guess, whenever we actually come across this, especially for those, the mum and dads who are starting out to be developers, when they typically going back to the previous topic, they tend to get a real shock when they look at the costs involved in the interest rates and also the legal fees when it comes to property finance. I said to them, look, you just need to sort of, that's the kind of numbers you need to get familiarized with. And that is, everything comes at a cost, and that needs to be added as part of your feasibility study. If it's not profitable, if you include those, you kind of have to sort of reassess it. And these days, especially for those who are self-employed at the moment, when I come across them, if they have a liquidity issue or cash flow issue right now, I do ask them, are you sure you actually want to head into this? Because we hope for the best. Everything should hopefully go back to normal in the next 2 or 3 months. But can we actually rely on that prediction?
Thanks, Johan. Appreciate that, mate. So I've got a question here from a K Wong. Don't know their first name, just the letter K. But they're saying some experts believe that Australia is heading towards deflation, which is kind of the step after recession, with, I guess, the valuations of property dropping off significantly. And some are saying that that's already happening. So what's the panel's view? It's kind of one of the opening questions we asked with, but I guess from a technical point, I think we're about to trigger a recession from a technical perspective, but do we think that's going to go, I guess, to the next level, gents?
In terms of what does my crystal ball say, I understand the government is borrowing money and perhaps even printing money. Generally, when that happens, prices go up. Does that mean we've got an inflationary recession? Quite possibly. But it comes back to, is this a long-term change in the economy, or is this something that's going to affect us for the next year or two, and then life will go on?
Mark, it looked like you were biting your tongue on something there, mate.
Yeah, I'll just go on. This is all crystal ball stuff, and there are so many different forecasts that are at opposite ends of the scale. And that's not just the media talking. I mean, even when you take billionaire hedge fund managers who supposedly are the best forecasters in the world, and they're all divergent thoughts. So, yeah, everyone's guessing, and your guess is as good as mine in reality.
Yeah. So we've actually gone past the hour, gents, and I can see plenty of questions through. So what I'm trying to do is just skip ahead and see what ones that are very similar to what we've already had. So I think we might just selectively ignore some. So apologies if we're not answering any direct questions, but a couple of comments about people that are definitely getting valuations under where they believe it should be. So a couple of people asking about COVID clauses with regards to making sure that, if there's any delays in settlement and things like that. Are you guys seeing a lot of COVID clauses being added in at the moment?
Yeah, absolutely. The clause is the valuation's only good as at today. As to the real effect, I don't know. I mean, look, at the end of the day, a valuation is still supposed to be good for 3 months. If your lender is signing off 6 weeks after a valuation was done, I mean, it would be a pretty silly valuer, I think, a pretty silly lender to be saying, I want another valuation now. At the end of the day, when you're lending not for the purposes of a 4-week loan. If you're lending with a 6-12 month loan term, then a difference in valuation, whether it's yesterday or 3 or 6 weeks ago, is probably not going to make any difference. So clauses are clauses, and don't get too wrapped up, hopefully.
Probably a bit of a warning for those who are borrowing from the traditional banks. So something I probably should also mention is, especially with the residential lending side of things, what we're seeing is that they are potentially doing, for example, employment checks after approval. So you may already have gone unconditional on the contract, but they're actually doing employment checks, for example, 2 days before settlement. When they actually do those kind of things, so providing if you have, if the applications were lodged truthfully, i.e., for example, if they've actually asked you, number one, are you currently being affected by COVID-19? And number two, do you foresee any changes to the business side of things or your personal circumstances based on COVID-19? Providing if those questions have been answered truthfully, we tend to see that even if it does come to the point where, say, for example, you were employed, but you are no longer employed, or you're now on JobKeeper at the time of settlement, we've actually seen lenders putting customers, they settle a deal, but they basically put the customer on life support immediately after the settlement. So I think, as Mark said, clauses are clauses, and, contracts, I think, once they've actually contracted, so long as the application has been done in a truthful fashion, I think there's still risks, but it's probably less of a concern.
So I'm seeing another comment here from Alex. It says, I'm hearing a lot of property commentators mention that this is a health crisis that's having an economic effect, but that the property fundamentals underneath it are strong and will continue to remain strong afterwards. Everyone, I guess, have a similar point of view in that regard, or?
I think the property fundamentals are unchanged. Whether they're strong or not, that's also open to interpretation, because there are certain sectors which I believe are strong and there are certain sectors which I believe might not be strong. Yes, this is a health crisis. The fundamentals of our economy haven't changed.
Yeah. But Eric, you've been a bit quiet there for a little while, mate. What's your call on it?
Oh, look, at the end of the day, this is a health crisis in reality. No one's really dealt with this or similar before. It's more of just really keeping things calm and cool and carry on. At the end of the day, most of our clients' projects are 12 to 18 months to completion. So it's more of like, look at the market, where would it be in 12 to 18 months? That's more the longer term view. Where the valuers right now, yes, they can jump to being more conservative, or lenders might put more pressure. We had a case where a evaluation was done just about 4 to 5 weeks ago, and yet the lender made a comment, so they'll probably like to see a refresh on that. So not a full report, but just a refresher. And in their opinion, they probably would have seen it drop slightly. So that's interesting. But at the end of the day, the world's not going to fall down. At the end of the day, people need to live, people need to have property to live in. Things will carry on slightly more subdued, but they will carry on.
So with that in mind, and might make this the final question, how long do we think that I guess we're going to have this overly cautious market and that we're going to be a little bit repressed?
My personal opinion is that it's probably a global question. I think Australia's economy on a local basis is looking very good compared to the rest of the world, and that's certainly very much a relative statement. Unemployment is still going to be a relatively ugly number compared to what we've had for the last 30 years. So there is still a risk there. The virus is obviously currently under control, and we're certainly a world leader. There's no doubt about that. Big concern, I guess, is as they start to let us go back to relatively normal society, is what will happen with the virus. If we go into another lockdown, then that'll trigger a confidence problem, and confidence is always a big factor with stock markets and property markets. So hopefully the government and society keeps the virus under control. The big unknown, I think, in my mind, is the global factor. The saying's always existed that when the US sneezes, the world catches a cold. Right now, the US, from a viral and economic perspective, is sneezing and coughing and carrying on.
I think it's got a coughing fit. Yes.
So yes, I mean, who knows what's going to go on there. Yeah, I mean, the one thing that the US does have is being the reserve currency of the world. They do have the ability to print a hell of a lot more money and keep their economy going for a lot longer than what the rest of the world can. I mean, everyone's got their opinions on what's going on with the US. So, I mean, at the end of the day, look, there is a risk there. So as much as we keep Australia in relatively good standing, there is still a risk globally. And again, it's just the crystal ball factor.
Yeah. Anyone else want to add to that one as parting gestures, folks?
Yeah, I will. Look, property cycles are a part of life. We have booms, we have busts. 2008, 2009, we had a global financial crisis. Our prices were affected. We've had some recovery since then. There is a suggestion that our markets topped out 2 years ago, and we've been a little bit wobbly since then. Some people believe that, some people don't. Who knows what's going to happen in terms of our economy over the next year or two? Is tourism going to suffer? Hospitality, immigration? Are our trading partners going to be there for coal, meat, and barley? We don't know any of this, but the cycle will continue. And let's look where the government is spending money. Let's look where the government incentives are. We haven't really talked today about NRAS or NDIS or things like that, but the government puts money in certain places and deals stack up because of it. There's infrastructure being spent. Go there. The opportunities are still there.
Oh, I 100% agree. The opportunities are still there. As a matter of fact, I think there's opportunities are plenty are coming is kind of my point of view on it. Yeah. Eric and Johan, any parting thoughts, gents?
No, all good. I share the sentiments with the other two gentlemen.
At the end of the day, we always talk about property as being look for the pie. So the pie is population growth, infrastructure growth, and employment growth. So as long as those fundamentals are there, life should continue on. So everyone do your due diligence and take action, make it happen. There's a lot less competition out there. So make hay where sun shines.
Excellent. Well, thank you, gentlemen. I just want to say a very huge thank you to you all. And for everyone who is actually watching, thank you for your questions. Today, we've had Eric Trieu from Holden Capital. We've had Mark Trainer from Stack Capital. We've had Krishna Pabari from Acquire Capital and Yuhan Liu from Mortgage Choice. So if any of you are looking for any deals in and around the specializations where these gentlemen are, I'm sure that they would be more than happy to deal with you post this session. As a matter of fact, what we'll actually do is we'll actually put your contact details into the links, gents, so that people can reach out to you directly afterwards. So thank you very much. Really appreciate you coming on board and helping out this weekend. It's been a very popular topic, seeing how many people we've actually had on the live today. And generally these things then keep pushing out for the next week or so as people keep watching. I will take the opportunity to say that we're actually launching an event in 2 weeks' time that I'm actually calling the Perfect Storm, because my personal point of view is that, yes, this economic impact has happened to us. And I think that you don't want to catch a falling knife, but I think that all the market drops that they're predicting are going to have an inevitable end. And right now is the time to actually prepare yourself for what's going to happen at the end of those drops in order to pick up properties on the other side as we inevitably will recover. Because every single time we've had, whether it be a GFC or a recession or a world war or anything like that, the market's dropped for a while and then it's picked up and then pushed on harder. So Australia is about to be on sale, and now's the time to prepare for getting ready for doing that. So I'm going to put some links in that event. It's 2 weeks from today for anyone who wants to come along to that. But other than that, gentlemen, I want to thank you very much for your time. And yeah, I guess we'll put your contact details in the links below. And thank you very much for your participation today.
No worries.
Thanks,
Glad to be
guys.
invited. No worries. Cheers, guys.
Cheers, guys.
Thank you very much.
Bye, everybody.
Bye.